But before moving to that point, I would like also to pick the brains of Dr. Vladimir, and thank you again for being with us here, Doctor, on the natural catastrophes, particularly and nat cat perils, how they impact the portfolio and the pricing of the reinsurance, particularly in areas that are not so exposed, like for example some of the areas here or countries in the North Africa and Middle East are not so exposed to natural perils like other countries. So where did that come from? The pricing? What are the pricing models that are in use? How we can capture the right data so that the pricing also become adequate? Some of the things that we have noted throughout our experience, that when you provide the same set of data to 2 or 3 different cat modelers, they come back with different outcomes. If you can highlight that to us, Doctor, the floor is yours, and thank you again for joining us.
Thank you.
Please, Dr. Vladimir.
Thank you, Mr. Moment. Thank you for the introduction, and thanks very much to the whole Federation FAIR to be invited to this session and to this webinar. Let me now, in my slot, introduce the basic principles of the cat modeling and address the topics which you just raised in your introduction. I will now try to share my presentation on the screen. Hopefully, you will be able to see it.
Not yet, Doctor.
Just a second.
Okay, now we can see it. Thank you.
Okay, I will switch to the slideshow mode. Is it visible? Okay.
Yes, visible, Doctor.
Good, thank you. So basically, as just mentioned by Mr. Mohamed Mahran, natural catastrophes and climate-related risks is one of the 3 wars we are now fighting. And even if you just mentioned, and very correctly, Mr. Moment, that especially North Africa and Middle East are not very well exposed regions, we have to accept one single fact, and this fact is that the natural catastrophe can strike in any place of the world. Of course, with different frequency, with different severity, but it can basically occur everywhere. So all those types of natural catastrophes which I have on the screen, geological, hydrological, meteorological, wildfires, or even space disasters, which sound very unlikely but might happen, can occur in the region where the federation has its own members. Now, when we look back in the past, of course, you will not be surprised that the catastrophe and weather-related losses caused to the insurance and reinsurance industry are increasing. So every decade is becoming more and more expensive than the previous one. Where does it come from? Is it related to the worsening hazard, worsening climate? Is it related to the economic growth and population growth? We can hear very often the arguments that the climate is changing, climate is worsening, and it should have an impact on reinsurance pricing. So where does the worsening come from? Let's have a look on the next slide. What we can see here, on the left-hand side, you can see the population growth since 1970, and the population has more than tripled. On the right-hand side, you can see an anomaly of global temperature. And indeed, the global temperature is growing as well. And currently, on the global level, we are plus 1.1 degree warmer compared to the situation before the Industrial Revolution. So yes, the climate is changing, and globally, the warming exists. But it's still not entirely clear to what extent does this impact the occurrence and severity of natural catastrophes. Because one should differentiate between hazard and risk. On this slide, I have 2 pictures. One of them is city of Shenzhen in China now, and the same city in 1964. So you can see that basically the landscape has changed completely. Lots of expensive properties were constructed, and this is probably way more important than any possible changes in climate and weather-related perils. So I would even say that the growing risk is more relevant than the growing hazard, which is a result of natural processes. But in the end of the day, it is all becoming expensive. But let me go back very quickly to the climate change topic again. The climate was changing throughout the whole history of the Earth. So here we have the fluctuations of global temperature over the past 540 million years. You can see that the fluctuations were enormous, and many periods were much warmer than we are now. We are now living in a relatively cold period. So the question is, do we need to be concerned? And the answer is probably yes. We shouldn't ignore the current situation, because what is concerning is the speed of change. And the speed of change, we can see it here. So here we are looking some 2,000 years back. And again, we can see very nicely regular or irregular fluctuations of the climate. But what we can see over the past, let's say 100 years, it's a big jump. And this is probably something which we need to be concerned about. So this was my introduction, just to briefly talk about catastrophes in general and climate-related issues. And now I will continue with the modeling to understand which modeling capabilities do we have and which models do exist. So very simply saying, the catastrophe modeling is as old as the property insurance. Even some 200 years ago, people were trying to quantify the accumulations of insured properties in case of large fires. So at that time, fire was considered very serious event. There was no mitigation, no fire brigade, so it was really serious. But really, the first real catastrophe modeling companies occurred only in late 1980s, and it all started in United States. Currently, at the moment, we have 4 large catastrophe vendors with very well reputation. RMS, Risk Management Solutions. This is probably the most well-respected one and the one taken by reinsurers the most seriously. Then we have a provider, VRisk, formerly known as AIR, Applied Insurance Research. Then we have CoreLogic company with many models available for Africa, Asia Pacific, also Middle East, and Impact Forecasting, which is a catastrophe modeling company, which is owned by Aon. So it's basically a broker catastrophe model vendor. What are the models available in our region? Here I'm focusing mostly on Africa, Middle East, and South Asia. In this map, we can see which earthquake models are available from those 4 vendors. You can see lots of gray areas, especially in Africa. On the other hand, quite a sufficient coverage in South Asia and Gulf countries, but really lots of gray spaces in Africa. So as mentioned by other panelists, really lots of uncertainty and lots of unmodeled perils. When we look at the same map from the perspective of weather-related catastrophes, it's probably even worse. We have even less models for weather-related events. To a large extent, African countries not covered at all. On the other hand, quite a sufficient coverage for countries affected by tropical typhoons, which is India, Philippines, Indonesia, and the islands in Indian Ocean. Now, very briefly, I don't want to overload you with technical facts. I will try to explain how the probabilistic CAT model works. We should remember 3 steps. The model always works with insured locations, and this is the data which our clients, insurance companies, are able to provide us. So the modeling is as good as is the information which we enter into the model. Then the model generates thousands and thousands of stochastic events, from very small events up to very, very extreme events that never happened so far, but they might theoretically happen. And the hazard, like wind speeds, water depth, earthquake intensities, is then converted by the model into the financial losses through so-called damage functions, which translate the hazard intensity into the damage ratios. On the top of it, we have some financial engines that calculate monetary losses for individual events and translates them into the exceedance probability curves. And this is already the relation which you probably know, the relation between the probability and financial loss which your company might expect. We will come to more detail on a later stage. This was just an introduction to explain how the CAT model works. So let's have a look how we can use catastrophe models for risk quantification and not-CAT risk pricing. Reinsurance was the very first segment of the insurance industry that adopted catastrophe models. And it all started with very simple but very logical questions like, is my portfolio exposed to natural hazards? And if yes, what is the main peril and what are the monetary losses I can expect? Then, if the not-CAT risk is somehow material, then what is the reinsurance protection which I need, and what is the decent price I'm expected to pay for that? What is very important that actually for placement of catastrophe treaties, the modeling is essential. And the most typical outcome of the catastrophe modeling, we can see it here on this picture. It's a relation between the probability or return period on the x-axis and monetary loss which your company can suffer on y-axis. Of course, typically, multiple perils can be present for the CAT capacity or a proportional event limit. We are always looking at the main peril, but also secondary perils might be very relevant, especially for pricing of lower non-proportional catastrophe layers. Now, again, here we are looking at the model output in a more detail. So here we have the well-known exceedance probability curve, sometimes expressed as a table with individual return periods, let's say from 5 to 1,000 years, and monetary losses. At the same time, we might even have a so-called event loss table, which is a list of all stochastic events and their losses, which can be conveniently used for pricing the catastrophe contracts or for structuring and optimization of the reinsurance treaty of our client, which is an insurance company. When looking at the results of the catastrophe modeling, you can typically see also 2 different representations. So-called occurrence perspective, OEP, which basically quantifies the one maximum event that might happen within 1 year. And this is typically used to take a decision about the catastrophe limit, or annual aggregated perspective, which is a sum of all events which you might suffer throughout the year. So the AEP perspective, the annual one, is typically higher, while the OEP is lower. Here I have one nice example where I show the difference between annual and occurrence perspective for individual return periods and for India earthquake and typhoon. So earthquake is light blue, tropical storm is dark blue. What is very relevant is the fact that for earthquake, you can hardly have on a frequent basis multiple events per year. However, for tropical storm, the annual aggregation of losses is quite material And let's say for some short return periods, we can see that the presence of multiple events in 1 year is quite frequent. And this is, of course, something which creates a pressure on the bottom layers of catastrophe contracts, where the relevant weather-related catastrophe perils are present. So those were the individual perils, and of course we shouldn't forget that multiple perils can affect the catastrophe contracts. So typically, the decision about the capacity and limit is taken based on the main peril, which in many cases might be earthquake. It would be, for example, in the Gulf countries, certainly in North Africa. It's not entirely clear what would be the conclusion for Southeast Asia or other African countries, but very often there are many other perils which are not that relevant to set the catastrophe limits, but might very materially impact the bottom layers of catastrophe contracts, and even worse, the net retention of the insurance company. So typically the secondary peril might contribute with more than 1/2 to the bottom layers, can cause substantial deterioration of the company net retention, but of course, they are not a major drivers of the top layers and catastrophe capacity. But of course, those perils need to be properly considered to understand the proper structure and pricing of the reinsurance contract. On the maps, which I shared with you in the previous slides, you had a chance to see that in many territories, there are no models at all. So we should have in mind that not all the perils are modeled. An example, let's say, flooding in North Africa. I'm not aware of any model vendor which would have a model for a North Africa flood. But of course, there are multiple models for earthquake. So some perils are not modeled at all, but they can be present. And at the same time, even if certain peril is modeled, it can have some unmodeled components. Like, for example, fires caused by earthquakes. Hardly any models in our region do capture the fires that might be triggered by earthquake. Also, tsunamis triggered by earthquakes. This is also very frequently not modeled. Similar to that, precipitation flooding caused by typhoon is not covered by every model. So anytime we look at some results of catastrophe modeling, we should ask ourselves, or we should ask the provider of the modeling service, which perils and which effects are properly modeled to make sure that our reinsurance contract is structured properly. Of course, in some cases, we can even have multiple models. And as mentioned by Mr. Moman in the introduction, it can easily happen that the reinsurance company will send the data to 3 different brokers and receive multiple different outputs. And it can indeed happen. To a certain extent, there is of course an uncertainty around the data which we receive and around the assumptions which we adopt for the modeling. But at the same time, there can be many differences in the modeling software itself, and that can be given by the different assumptions of around the hazard. So, for example, the frequencies of stochastic earthquakes or typhoons are very different. Also, the vulnerability components of the models might be different. So, the way of how the hazard severity is converted into financial damage might very differ model by model, and also the individual models might react with different sensitivities to the specific risk profile of the individual companies. What can I do in such a situation? Of course, I should understand the models and I should understand the differences. There might be multiple conclusions. The user of such different results might choose one single model based on the evaluation of the outputs and evaluation of the models. You can adjust a single model, or you can even blend multiple models to create some average. Even this is an approach which some companies take. So my colleague Mohammed will talk a bit more about catastrophe pricing and how the reinsurers price the reinsurance treaties. I will only briefly mention on these slides how the pricing works from the technical perspective and what drives the pricing of the catastrophe treaty. So in the first place, it's for sure the company or market loss experience, but also the general perception of the NatCat risks in case there is no experience at all. And for example, in Gulf countries, when it comes to earthquake, there is really no loss experience at all. Then, of course, the pricing is related to the exposure and NatCat modeling results. So reinsurers are typically looking at the modeled expected losses as they are generated by the models to the individual layers of the catastrophe treaties. Also, volatility of the modeled losses is important, and also the probability of attaching and exhaustion of the treaty. So, of course, the treaty, which is attached every 5 years, is priced differently compared to the treaty which is attached every 20 or 50 years. And of course, the outputs of the catastrophe modeling can be used very conveniently for additional optimization of reinsurance purchase. So before the insurance company goes to the markets, it's up to us, up to the broker, to advise with the best possible structure, which protects you, and at the same time, it creates some reasonable balance and compromise of the proper protection and reinsurance pricing. There are also some global aspects that impact the pricing and that can be affected by the modeling. It's for sure the global catastrophe activity. So as mentioned at the very beginning by Mr. Mohamed Mahran, the large catastrophe events like Hurricane Ian in the US, Gulf of Mexico, that will impact the pricing everywhere. It's also about the global reinsurance capital and its availability, but it is also about the diversification benefit of some territories. So for example, Africa or Asia would be perceived differently than the key and most expensive territories like United States, Japan, or Western Europe. And in my last section, which will be relatively short, I will only briefly mention the importance of the data which we receive for the purpose of catastrophe modeling, because there's also uncertainty around the data, and the modeling outputs are only as good and as accurate as is the data. So the catastrophe models, they can work with multiple assumptions, and they can differentiate between multiple types of the property. So the model can take into account the enormous level of details about the occupancy of individual insured risks, insured coverage, construction, age, height of the building. It can model multiple insurance and reinsurance terms, not only policy limits, sublimits, deductibles, but also the reinsurance facultative and obligatory contracts. I would like to focus on a couple of details which we believe are important to be captured in the NatCat modeling data which we receive for the modeling. So first of all, it's the occupancy or the economic activity of the insured risks. We typically differentiate between the main groups, which are industry, commercial objects, householders, and many other subcategories which can be reflected by the models. Of course, when subjected to the ground shaking, to the severe storm, each object reacts differently. Now, of course, the construction of the risks needs to be taken into account very properly, because in many countries, the very strict and proper design codes are imposed by state. And if the buildings are built properly, they can resist and they can sustain substantial levels of the ground shaking. So another parameter which we might take into account. Also, the other details like insured coverage, buildings, contents, BI, which is basically very, very much loss-making, can be reflected by the models, and it is something which might impact the results, which are then communicated to the reinsurer and which are used to structure and design the reinsurance contract in the proper way. Last probably point which we should take into account is the proper information about the location of the insured risks. The models can typically work with multiple different resolutions. So if we receive the data on some low resolution units like governorates in Egypt, we can really work with it, but we have to apply simplifying assumptions. Therefore, it's much more convenient to provide some finer divisions, like, for example, individual districts, addresses, or coordinates of the individual risks to make sure that it's really modeled properly with highest possible resolution. And the last information, which we shouldn't ignore in the NatCat modeling data, is a proper capture of the insurance and reinsurance terms. So, for example, if the company applies the sublimits for natural perils, it needs to be properly reported and reflected in the model. Same with deductibles, and same with the underlying proportional contracts like facultative, quota share, and surplus treaties. So this is basically it from my side. And to conclude, I would say that catastrophe modeling gives us a very important opportunity to model the risk properly under the current challenging market conditions. It can take into the account a wide range of scenarios, even scenarios that sound very impossible, very unlikely, but they can happen even in regions where we haven't seen that much of catastrophe activity in the recent decades. And the models can reflect many details about insured properties, and very often the models can take into account much more details that are currently reported by the insurance companies in the other regions. And last but not least, a catastrophe model is an important weapon for a broker to help insurance companies to structure and place the catastrophe insurance. So, colleagues, this is it on my side. Thanks for the invitation. Thank you for your attention, and of course, happy to answer any questions once the situation allows.
Thank you so much, Dr. Vladimir. This is very interesting, but at the same time, still it shows us how complicated is the CAT modeling, but at least you have given us in simple form and simple words at least the basic idea about it. And actually, as you have mentioned, Doctor, that you are not only modeling the CAT events that have already happened, but also the ones that could happen, and we don't know when it will happen and when and how bad it will strike. And I recall, I mean, from my previous service in the GCC, that the heavy rains were happening, I mean, regularly. But because of the buildings have taken the natural paths of the rain going to the sea, actually the flood of water have gone somewhere else and has actually covered districts that have never seen floods before. So actually, it is a multi-dimensional issue. Either it is because of the global warming and the extreme weather patterns, but at the same time, the urbanization and the heavy construction and inhabitation of the areas that, as you have mentioned and have shown us, in 1964, it was only like a valley with very few small buildings, but now it is high rises and very congested area, full of occupants and full of values. So these things actually affect definitely the pricing and at the same time the view of the CAT modelers. One of the most important things you have mentioned, Doctor, as well, is the capturing of data, because we need to know how these buildings are built, from what material, how many stories, what are the contents and that are stored in this building, because all these things affect the pricing and modeling of the CAT exposure. I just would like to mention now that we are currently having 232 participants. A few minutes ago, there were 234, now 233. So this shows how important and how interested the people are in such important webinar and discussion topic.